In his 1988 letter to Berkshire Hathaway shareholders, Warren Buffett shared a story about how he made some easy money as a 24-year-old living in New York City. There was this public company called Rockford & Company that made candy, and it bought a lot of cocoa beans at 5 cents per pound. Now there was eventually a global shortage of cocoa beans, and the price spiked 12 times in value from what Rockford paid to 60 cents per pound. Now this candy company actually wasn't doing very well at the time. It made a lot of sense to profit off of something that it had in inventory. It looked like a genius move, but there was one problem. If it sold cocoa beans at the going rate, it was going to be faced with a very large tax bill. That wasn't something that the company wanted to do, and that's when it came up with an unusual idea. Rockwood actually wound up finding a tax loophole that would allow it to profit off the rise in the price in cocoa beans. The loophole was it decided that it was going to trade its stock for the cocoa beans. And that's when Warren Buffett spotted a sweet opportunity. For weeks, Warren Buffett would buy Rockwood stock, then he would exchange that for cocoa beans, then he would ride the subway down to the exchange and trade in his warehouse receipt of the cocoa beans for the going price. The reason it was a good idea was there was a gap in price between Rockwood stock and the price of cocoa beans, and that gap in the price between the two is what is called arbitrage. Buffett says that arbitrage is the process of exploiting tiny price differentials, like the difference in the price between Rockford stock and cocoa beans. And over the years, this is actually one of Buffett's favorite investing strategies. In fact, he's betting big on one right now. Last year, Microsoft agreed to buy video game company Activision Blizzard for $95 per share. But Activision stock actually trades well below this buyout price. So, over the past year, Warren Buffett's company, Berkshire Hathaway, has been buying a lot of Activision stock. It currently owns about 4.5 billion of the stock, and it acquired this stake at around $78 per share, which means that if the deal actually winds up going through, Berkshire Hathaway's position could go up 20%, which means it would make about $1 billion. Now, over the past year, I have voraciously studied Warren Buffett, trying to become a better investor myself. And I guess he's starting to rub off on me because in January, I took 6% of my portfolio and invested it into an arbitrage opportunity. And that arbitrage opportunity is Amazon's proposed acquisition of autonomous vacuum cleaner company iRobot. Okay, so in August, Amazon agreed to buy iRobot for $61 per share. Now, if you look at where it is trading right now, it's trading at less than $45 per share. Let's just assume for a minute Amazon actually winds up buying iRobot for the predetermined price. Anyone who goes out and buys iRobot stock for, say, $45 per share would instantly make more than 35% return when Amazon winds up buying those shares for $61. When you consider that the stock market goes up about 10% per year on average, and that this deal could close at any time, the annualized return on this arbitrage opportunity is very, very good, and it's why it's an opportunity that I personally jumped at. This is probably a good place to explain why arbitrage exists in the first place. Sometimes it's an information thing. So like in the case of Warren Buffett and Rockwood, not everybody knew about this. And you gotta remember, this was back in 1954. Information wasn't readily available at everyone's fingertips like it is today. That kind of a situation favors someone diligent like Warren Buffett, who goes to the extra work to find the information gap and exploit an opportunity. Finding and exploiting an information gap probably isn't gonna happen in 2023 because of the proliferation of information. Nowadays, arbitrage opportunities in the stock market typically exist where there's significant doubt that the transaction would even go through. So when looking at these acquisition arbitrage opportunities, Warren Buffett says investors should ask 4 questions. Number 1, how likely is it that the deal is going to go through? Number 2, how long will investors have to wait? Number 3, what are the chances of something better, like another company comes in and offers a better price? And number 4, what happens if it doesn't go through? As I answer those 4 questions with iRobot stock, it maybe isn't the best arbitrage opportunity, admittedly. So number 1, how likely is it that it will go through? I would personally say very likely. Yes, many senators have come out against this deal, including Senator Elizabeth Warren. People fear that Amazon is invading people's privacy, and with a company like iRobot that maps people's houses, they're going to have an unfair advantage into knowing the insides of people's homes. And I'm not a legal expert in any way, but as I understand the law, prosecutors have to be able to prove beyond a reasonable doubt that this deal for Amazon acquiring iRobot is bad for consumers and bad for competition. While you could certainly make arguments that it is, I don't know that that could actually be proved. So that's why I'm willing to personally bet that it is very likely to go through. As to how long it could take, I would think that it would be in under a year from the time that the deal was announced to the time that it actually goes through, which would be another 6 months or so. Looking at the percentage right now of the stock versus where it would be if Amazon did buy them out, that 35% or so arbitrage, that is a very good annualized return, and the reason why I think it's a good risk-reward scenario. The Buffett's third question, the chances that a better deal comes along, I would think that the answer to that question is exactly 0 chance. After Amazon announced that it was acquiring iRobot, iRobot started having some operational problems. They're burning through some cash. I don't think that this company is as attractive as it once was as an acquisition target, so I don't see another company coming in and paying more than what Amazon is paying. And number 4, what happens if this goes wrong? And this goes to what I just said. iRobot is struggling a little bit operationally right now. So if news came out that said that the deal was off, I would imagine that this stock would drop. How much it would drop is anyone's guess. My guess would be somewhere in the 15 to 20% range. Obviously, that's not ideal. It's not what I'm looking for as an investor, but I think that the odds of that happening are fairly low. The downside is mitigated. This is still a company that is capable of profits. In short, I don't see any chance of this going to 0. So that's why I'm willing to bet 6% of my retirement portfolio in this arbitrage opportunity right now. I definitely could be wrong, but it is a risk that I'm willing to take. Let me know what you think. Do you think that this deal will go through? I'm curious to hear your thoughts. I'm sure that there's people with better information than mine from a legal perspective. Anyways, thanks for watching this video, and we'll see you in the next one.